It's Thursday, one of the days in October. I'm not sure what it is. I'm a little distracted because, as you may or may not recall, I have a tax deadline in 4 days, 5 days, and I still got quite a bit of work on my desk. But I don't want to shortchange you on the time that I've promised to give you from the Red Shoe Business Club. I'm Mike Wright with Tax Right, the sponsor of the Red Shoe Business Club. Today we're talking about something that is very important, financial statements. We will talk in the future, before this series is over, about a simple and easy and powerful tool that you can use to keep track of your business finance. A tool that is of day-to-day usefulness. But that tool is based upon the idea that you are maintaining records in the traditional form that are important to be able to share with others who have a stake in what your business is doing. Your bankers, the IRS, other investors, partners, maybe even your spouse. And the traditional financial reporting is done through documents called financial statements. You already know this. We talked we talked exactly a week ago about the income statement, or commonly called the profit and loss statement. And for many people, that is the primary document that they look at to see how their business is doing. Well, what I'm going to show you today is the document that really shows you how your business is doing, because it provides you with an historical perspective on the operation of your business, whether that history is a day old or whether it's 30 years old. The balance sheet that we're going to talk about is the item that tells you where your business stands from the standpoint of wealth and stature. So let me refresh your memory with what we talked about last week. You'll remember that I pointed out that if you had $1,000 in income, it shows up over on the balance sheet as $1,000 of assets. But if you have a $100 expense, that shows up on the balance sheet by reducing the assets by $100, which makes those $900. And so that you pay that $1,000 and that reduces the assets. But let's say, for example, that you get another expense for $1,000 which you finance through a credit card or some other accounts payable. That $1,000 doesn't show up as an expense. That $1,000 shows up as an expense, but it does not reduce your assets by $1,000. Instead, it becomes a liability, $1,000 liability. And so if you write a check for $100 to pay that expense, it doesn't show up on the profit and loss. It shows up over here as a reduction from $1,000 to $900 in your liability, but also as an additional reduction in your assets from $900 to $800. So this may give you a profit report of where your business is today, where your business is over the period of time that your profit and loss statement is put together. But this is the document that actually shows you where your business stands. And so let's look at that in detail today. Now, if you'll remember, we had $800 in assets remaining on the last profit and loss statement. We had $900 remaining as unpaid liabilities. Well, what does this tell us? The formula for a balance sheet is this. Assets equal liabilities plus equity. Assets equal liabilities plus equity. This part of the balance sheet, the total of this part of the sheet has to equal the total of these two parts of the sheet. But to put it in a way that shows you what the wealth is of your company, let's change it. And let's say that equity equals assets minus liabilities. You'll all remember from your algebra that when you change a formula around and you work around the equal sign, what's a positive here becomes a negative on the other side. So to be left with equity as the solution of our formula, we have to take assets minus our liabilities. And we have $800 in assets, but we owe $900, which makes our equity minus $100. Look, this asset is cash. But let's say part of our assets are buildings. And let's say the buildings have a total value of $100,000. Well, now our assets are $100,800. Our liabilities are $900. So instead of equity of minus $100, we have equity of $99,900. The real wealth of the company is based not just upon the cash, which is all that the profit and loss shows. It's also based on the other assets that the company has. And so with these building assets totaling $100,000, the company is in pretty good shape, even though they may have liabilities of $900. However, let's say part of the liabilities that the company has are the mortgages on those buildings. And let's say we owe $50,000 on those buildings. Okay, this is accounts payable. This is mortgage. $50,000. And so now our equity becomes $49,900. Still not bad, but less than what it was before. It's the balance sheet that tells you what your company is worth because of this equity. And let's say at the end of the year, you make a profit. So when you report on your taxes, what you made for the year, you have a profit of $100,000. That profit is what's called retained earnings. Retained earnings is what's left over at the end of the year. This will change from month to month, but if we're using the calendar year that's most normally used for taxes, that's where that will come from. So now, if we have profits of last year of $100,000, plus we already have the $49,900, then you've got the total amount in equity. That 100K goes into equity and is added to the $49,900. Again, your company's in good shape. The thing to remember is that if you make distributions to yourself, or if you are set up in a corporate structure, let's go back to when we talked about S-corps. If you have a corporate structure and you make distributions to yourself, those distributions will come first out of your retained earnings, which means they're not taxable again. They're only taxable when you earn them. They're not taxable when you take them out, provided you have retained earnings. And the only way to know that is not on this year's profit and loss, but it's on the balance sheet where those retained earnings are kept up on a running total. This document is a much more powerful indicator of the health of your company, the wealth of your company, than the profit and loss statement, even though not only you, but most other people look first to the profit and loss. The thing you want to remember is that if you remember when we talked about what makes a business, it talked about the fact that the intent has to be to make a profit, but the reality does not require that a profit be made. And for many businesses, they'll be in the situation where they can go several years make no profit, then have a very successful year, make a lot of profit, and then they can draw on that profit as time goes forward. The other thing you want to remember about a corporate structure, and another reason why it's a powerful tool, is that if you have losses, if you have net operating losses, which is back on your profit and loss statement, those carry forward. They show up on the balance sheet as negative equity. And those can be used to offset other income from an income tax standpoint, although they do remain as a balance sheet negative amount. But I once worked for a company that was created simply because they had such a large loss, such a large negative equity, and that equity is purchased when the company is purchased, that the company was able to have, on a cash flow basis, money coming through that was not taxed because they were using up the negative equity as the retained earnings were built back up. Remember, I said retained earnings are what's left over from last year's results. So if last year's results are negative, the retained earnings go down. If last year's results were positive, the retained earnings go back up. And at some point, if you're successful, they will go up to the point where the retained earnings are again positive, which then makes the wealth of the company larger again. These kinds of tools are something that your accountant can help you with. Don't make the assumption that what I've just told you applies in your particular case, because it may not. There may be other issues that need to be dealt with before those results can be obtained. Profit is always a positive thing, and profit is always something that you want to work toward. But the way the world is, profit is not always something you get. We've talked about that as well. What I'm driving at is this. You cannot just make your business decisions based upon what you see on the income statement, whether it's a profit or a loss, because depending upon other factors, as I called them yesterday, peripheral factors, depending upon those factors, that profit or that loss might be a tool that is to your benefit regardless of whether it's a profit or a loss. I at one time heard the statistic, I believe it to be accurate, but I've not researched it, that Amazon.com, you've heard of them, I know, Amazon.com went for almost 10 years without making a profit. And yet they continued to operate their business until they grew to the point where now, if they have a loss, it's because they're manipulating their cash flow and for tax purposes to make that loss appear for tax reasons. Okay, look, I understand that this is complicated, and I also understand that it really doesn't hit home for you. What you need is an opportunity to sit down with somebody and go over your books and see, not only for this particular period, but over an historical period, what those things mean for your business and what you can do about them. And of course, I'm available for that kind of consultation anytime you want. But if you want to have a better understanding of what's important about your business, yes, look at your profit and loss, but don't neglect to take a good, strong look at the balance sheet that you get. So that's it for today. I appreciate you joining me. I appreciate your comments too, if you have any to make. Otherwise, we'll see you tomorrow.